Michael Saylor has built a reputation as the ultimate corporate Bitcoin bull, yet for the first time since December 2022, his firm is selling. Moving 32 Bitcoin, roughly $2.5 million, is a minor adjustment for MicroStrategy. But in a retail market hypersensitive to the actions of major whales, it triggered a wave of immediate panic. Bitcoin broke its recent consolidation and slid beneath the crucial $71,000 support level. On the volume axis, an entity offloaded $1.2 billion in the IBIT ETF, absorbing $29 million in execution fees to exit quickly. Right now, the crypto market is trading heavily on emotion. Investors are hyper-reacting to perceived abandonment, leading to sudden sell-offs regardless of long-term underlying strategy. Analysts are calling this behavioral phenomenon rage quitting. High-profile investors are watching software and traditional tech stocks rally, and because crypto returns are currently stagnant by comparison, they are exiting their positions in frustration. Billionaire entrepreneur Mark Cuban recently stated publicly that he sold most of his digital holdings, claiming the asset has lost the plot. Contrast that surface-level panic with MicroStrategy's internal positioning. They are maintaining a $62 billion Bitcoin treasury, focused entirely on long-term shareholder accumulation rather than short-term price action. We need to look past the high-profile exits to see if these shifts are the result of deep macroeconomic currents quietly reconfiguring the financial landscape. A major part of those hidden headwinds is political. Regulatory gridlock in Washington, D.C. is actively capping the market's ability to grow. The crypto industry has been relying on the Clarity Act to provide definitive regulatory guidelines, but that legislation is rapidly losing viability. This gauge tracks the political betting markets. In a matter of days, the probability of the Clarity Act passing plummeted from a hopeful 61% straight down to a bleak 48%. Investor Mike Novogratz has pointed to political maneuvering and the public perception of slush funds within D.C. as specific barriers stalling the bill's progress. As long as lawmakers stall, institutional capital remains trapped on the sidelines, starving risk assets of the momentum required to break out. The pressure on liquidity extends well beyond the U.S. border. Tensions in the Middle East are escalating, particularly with the recent suspension of U.S.-Iran negotiations. Now approaching 93 days of extended conflict, critical global energy supply routes, specifically the Strait of Hormuz, are being physically strangled. The leadership at ExxonMobil recently issued a specific warning that global oil inventories are approaching record lows. If energy prices spike as projected, it acts as a global inflation tax that strips discretionary capital directly out of the economy, choking off the liquidity required for any risk-on market rally. Yet the most severe drain on market capital is happening directly within the tech sector itself. We are moving into a historically massive IPO season. SpaceX is preparing for an upcoming public offering with an astronomical projected valuation of $2 trillion. Additionally, OpenAI is weighing its own massive public offering shortly after the summer break. This illustrates a liquidity siphon. Attractive tech offerings absorb the world's investment capital, leaving alternative ecosystems dry. Historically, a mega IPO season signals the final stage of a cycle, projecting a broader market top by late 2026 or 2027. The Bitcoin network faces a liquidity drought as traditional tech giants absorb the global cash supply for their own massive public offerings. When liquidity dries up, retail investors behave remarkably like gamblers. If the slot machines go cold, they take their remaining chips and walk out the door. A large portion of the current retail crowd is a younger, gaming-focused generation. Facing a high cost of living, they take high risks to generate rapid returns. When the market stalls, they lose patience and exit. It is tempting to look at this speculative behavior and compare it to the dot-com crash, but historical speculative bubbles relied entirely on hype, eventually bursting because the companies lacked foundational revenue or utility. Major digital networks today operate differently. They command massive decentralized computational power and facilitate actual global value transfer. Retail fear is an unreliable metric for the health of the asset class. The crowd hasn't abandoned the underlying technology. They are simply waiting for outsized returns to materialize before they buy back in. While retail traders panic sell, the world's largest financial institutions are quietly laying down permanent infrastructure. SWIFT, the foundational messaging network for global banking, recently confirmed they are officially integrating crypto rails for cross-border payments. The scale of this integration is massive, with over 50 major global banks actively implementing these new digital rails. Once the initial frenzy of those trillion-dollar tech IPOs subsides, that capital has to rotate. When it flows back downstream into risk assets, foundational networks like Bitcoin and Ethereum are positioned to capture the bid. The current market panic serves as a temporary smokescreen. For those watching the infrastructure build-out, this correction represents a specific window of opportunity before the cycle resets. Let us know what you think in the comments, and don't forget to like and subscribe.